where are the specific examples of where you see cash or money or profitability or whatever you want to call it? Now, and I know they're different, but let's just use that as a general term. Where do you see the decisions going wrong that end up draining money?
Well, let's start from the point that the warning system is not there, right? That you don't see or you don't notice that the money is going away until it's too late, until it's gone. So with that aside, because obviously if you have that trigger, then you can look immediately at what's happening in that specific case. So that aside, I think there are sort of 5-ish main categories. Obviously, people, labor. We talked briefly about labor efficiency ratios. Like if you don't have the right labor to do what you need to do, it's a problem. Generally, it is that you're not getting the ROI on the people you have, and you can have various reasons. We discussed why A players leave. We discussed the lovable losers. People that you are holding on for the other reasons than economic ones, and that all costs money, pay cycle after pay cycle, and there is no stop to it until you put a stop to it.
Welcome back to CardCast. As always, I am here with Milan Vavirka. How are you, Milan?
I'm great. Good morning to Sydney and very rainy afternoon in Vancouver.
It's a beautiful sunny day here in Sydney. There might be a bit of a temperature difference, but that's just the seasons. That's the seasons. Okay, so as always, we're gonna shuffle the deck and see what comes up, and then we'll talk you through the card. And we normally have great conversations here, so I'm excited to see what comes up from the shuffle.
And we have a diamond card today. The diamonds are the systems, right? And usually if there is money involved, diamond card comes up.
Okay, that makes sense.
Yeah, absolutely. And so the title of this card is Where Did All the Money Go? Where did your money go, Ged?
So this is something we see a lot, where companies think they're very profitable, but the reality is they're not as profitable as they think they are. And this card goes into some of the reasons why. So what prompted you to create this one as a card, Milan?
Well, I think that it wasn't necessarily the illusion of profitability. It was more of the really, as the title says, where did the money go? So I'm talking to the CEO, and he says, look, I've been building this company, had it for 30 years. We're growing year over year, but there is just no money left at the end of the year. I'm barely paying myself. I'm like, my goodness, what is going on here, right? And it's not like I heard it the first time there. It was just so specific and such an extreme thing. Like, imagine putting 30 years, which is basically, for most people, that's their working career, into something, and then feeling like you have nothing to show for it. Depressing, right? But far from uncommon, I'm afraid. So that conversation sparked it, and I was like, well, what are the usual things that we often see CEOs do that are causing this drain? Trying to answer the question, where could the money go, and where you might want to be looking.
Yeah, and I think we often see the same sort of reasons. The not having a real grip on the mechanics of their business, the financial mechanics of their business in terms of money in and money out, where it's going, and when is the good time to make an investment, or when is the good time to be prudent, and just things like I often see CEOs, and I can't actually remember if this is in the card. I often see CEOs really neglect to account for things like bonuses, and all of a sudden they just see their profit at the end of the year, or the cash in bank, just suddenly getting sucked up because they hadn't actually calculated what impact things like bonuses were going to have, or that truck purchase, or that new manufacturing equipment that they invested in. unless you've got that forward-looking view, and we talk about planning in one of our other
Right,
cards.
yeah.
Unless you've got that forward-looking view on money in and money out, and where and when you decide to make those investments, it's really, really easy to suddenly realize that, our cash is not where we thought it was going to be.
Just you have to think about the cash and what comes out of accounting, for lack of a better word, is the ultimate lagging indicator, right? Because once that is, the money either is in the bank or isn't, there is not a hell of a lot you can do about it. And unless you have the foresight, it's like, if I do this, I expect the cash balance to evolve in this particular way. And is it doing it or not, right? If there is a difference, then I can be looking for reasons. But without that foresight, without that planning, so many companies and so many CEOs, and especially founder CEOs, fall into this ultimate reactive mode of financial management, right? When really okay, we are doing our stuff, the receipts are going to the bookkeeper, and at the end of the year, the accountant looks at it and gives us what the hell our tax bill should be, and that's it, right? That's sort of they're looking at it, and it's so such a misuse or lack of use of a fundamental tool that tells you whether your business is healthy or not. Because beyond some complexity, there is no way that one can hold all of that in their head and just swim.
Mm-hmm.
And this might actually be now when we're talking about it, one of the triggers that once you have a company of 5 people, you can keep it up, right? Once you start hitting hundreds of thousands and potentially millions of dollars in turnover, in payment terms and all of those things, you can't do it by seat of your pants anymore. But maybe you missed the moment when it ceased to be so, and where you need a system to start supporting you in the decision role. Otherwise, you're going to wake up like this, gentleman who was like looking, what the hell happened, right?
So where are the specific examples of where you see cash or money or profitability or whatever you want to call it? Now, I know they're different, but let's just use that as a general term. Where do you see the decisions going wrong that end up draining money?
Well, let's start from the point that the warning system is not there, right? That you don't see or you don't notice that the money is going away until it's too late, until it's gone. So, with that aside, because obviously if you have that trigger, then you can look immediately at what's happening in that specific case. So that aside, I think there are sort of 5-ish main categories. Obviously, people, labor. We talked briefly about labor efficiency ratios. Like, if you don't have the right labor to do what you need to do, it's a problem. Generally, it is that you're not getting the ROI on the people you have, and you can have various reasons. We discussed why A players leave. We discussed the lovable losers. People that you are holding on for the other reasons than economic ones, and that all costs money. Pay cycle after pay cycle, and there is no stop to it until you put a stop to it.
And that's often one of the easiest ways to retrieve money.
You would think so, but easiest in the mechanical sense is in let that person go. But it seems it's very, very hard, especially if it's a founder situation. You have a loyal person who's been with you for 17 years. They were great for the first 2. Again, very, very common. So I would not bagatelize it, because it is not easy it's simple, but it's not necessarily easy, which is why so many companies get stuck in that vicious cycle.
Yeah, and maybe that we need to create a new card about why people don't make tough decisions, because this is one of those decisions that is easy but tough at the same time. From a cerebral point of view, you can identify someone who is not contributing and probably costing the organization, and probably dragging their colleagues down at the same time. So you would think, okay, that's an easy decision. But as soon as there's people involved, it's no longer an easy decision.
Yeah.
But in business, we're there to make tough decisions because someone's got to make them.
Yeah.
And if you don't, you are going to see cash just flowing out the business for no return whatsoever.
Funnily enough, the next card in my draft folder is called the Decide How to Decide.
Right. Okay. So where else does money flow out?
Sometimes the founder or the owners themselves, and that has two sides of the card. No pun intended. If they pay themselves too much, or if they pay themselves too little, both of those are dangers. Right. Too much, obviously, if the company cannot afford it, like, my opinion, your company is doing great, you're leaving enough money to finance growth, you are properly capitalized, it's your company, it's your money, I don't care. But there is such thing as too much, which is when those conditions I just listed are not fulfilled, meaning there isn't enough money for the growth, there isn't enough reserve capital for in case of emergencies and so on. I see that sometimes, but not very often. What we see more often is that the founders are not paying themselves enough, and they're not realizing that it's actually a sign that the business model is not healthy. The card mentions Greg Crabtree's Simple Number, Straight Talk,
Yes.
Big Profit, which is that he has a whole chapter on this. So, in benefit of time, let's leave it to the listener to pick up that book and read it, because that is probably the best guide of how to spot those flags and what to do about them, and what are the best practices of how to avoid them.
Yeah, and this is often a real blind spot for founders and for CEOs, because I often ask the question: is your company profitable, and how profitable is your company? And they come back and say, "Oh, we're 40% profitable," and it's like, okay, well that's phenomenal. That's incredibly high. Now, are you sure you factored everything into that? And they say, well, I pay my salary out of that 40%. Okay, so you're saying your gross margin is 40%. Okay, so once you pay your salary, how much is it then? Oh, it's still 20%. Okay, so once you pay your distributions and your dividends, they suddenly start to realize that their business is barely profitable at all. Or they're choosing to pull all the money out of the company every quarter or every year, depending on what their distribution cycle is. And that's okay, but then that's then a lifestyle business. Now, that's not a growth business. So you need to be clear about, what are you actually trying to build? Are you trying to build a lifestyle business, or are you building a growth business? Now, you can do both, but you then got to make some very, very clever decisions about how you reinvest money in, and when you take those distributions out, and how much you take out. So that's a great example of, revenue is vanity, profit sanity, but cash is king. If you're paying yourself all the profits, it's just a lifestyle business.
Yeah, absolutely. And again, nothing wrong with lifestyle business if that's what you're trying to build, if that's what you're trying to do. But you must not kid yourself that it's actually something else than what it looks like. I saw a opposite example where the payment to the owners was done in a way, I believe, that they were billing it to a different company. That was the situation. So what happened was that it was just a straight cost for this organization. And guess what? There was a profit sharing program, and there was never any profit. This could be really, really abused, and obviously, suddenly you have a huge turnaround of people because you are trying to incentivize them on something that then you take away from them. It was ridiculous. But again, the key here is to understand your role as an owner versus your role as an employee or manager or CEO or whoever you are, right? What is the market cost, market value of the work you're doing for the company? And then what is your right as an owner? What do you want to do? Presumably, you want to be a good steward of what you created. But those are two very, very different roles. I think Greg Trepley would tell you, pay yourself as much as it would take you to replace yourself. That's a really, really good rule of thumb.
Yeah, sound advice by Greg there. Yeah. Mm-hmm. And if you haven't read Simple Numbers,
Great Talk, Big Profit.
I'll do it there again. Mm-hmm. Yeah. If you haven't read that book, you should.
Yeah, absolutely. Mm-hmm. Well, if you're listening to this podcast this far, that means that a topic is probably interesting to you, then you definitely should read that book.
Absolutely, yeah. And both editions as well, because there's a volume 2 that covers different topics around money and cash.
Yeah, that one goes more, if you're really a little bit farther in the finance side, it's really how to sustain, create sustainable growth in the organization. But the first one is essential. The second one is really, really valuable if you don't have a finance professional backing you up. Yeah.
Yep. So where else does money flow out? In a way that is often surprising to see.
Yeah, what is really surprising for people is that growth costs money. Right? That, we added $1 million in revenue. Fabulous. It cost us $600,000 and our gross margin is 35%. Guess what? That money had to come from somewhere, right? The difference. If you are in a recurring business, a recurring revenue business, that might still be okay because you'll get the money in the next year without that customer acquisition cost. It's fine. But if you're not in a recurring business, or if you are not expecting that future revenue, if you're not dealing with the terms like customer lifetime value and so on, you still have to make sure that you can finance that bridge until that relationship with the customer is going to return what you've put into it. And sometimes that takes years. And
absolutely.
And the money has to come from somewhere.
Yeah. I worked with a client it's a few years ago now, and they in theory had a very, very healthy gross margin, but they had no cash, no money, and they couldn't understand where it was going. And we pretty quickly came to the conclusion, or to the realization, that they were in a professional services environment and their sales cycle was really, really long. So once they did a deal, they could work out their gross margin. Okay, this is what we're charging the client. This is what it costs to deliver, the cost of sale. And yes, the gross margin looked pretty healthy. Where they were losing money, they were losing money in two ways. First of all, because the sales cycle was so long, once they allowed for the cost of the sales resources to win the deal in the first place, and once they allowed for the cost of overruns and rework that didn't figure in their theoretical gross margin calculations, they were barely breaking even. Yeah. And it should have been so obvious to them. It should have been right in front of their faces, but it's just not something that they were prepared to accept.
Greg would tell you to put your sales into direct labor. So it would, you would see it in your contribution margin.
Absolutely, yeah.
Instead of just having a massive over, because dealing with things like work in progress, or work that you've done but it's actually not being sold, effectively wastage, right? Those are a little more complex, but again, it's just a fairly basic business. It's so easy though for a founder CEO to get a sort of a financial tunnel vision, right? And looking at the numbers that make sense and that they fit, and and ignore the rest that is sucking money off left and right. The dilemma you described is like they have this great gross margin. Where is the money? And it probably wouldn't take very long investigation to any decent accountant to take a quick look and say, hey, this is where it's going, right?
We didn't even need to rely on an accountant. Once we opened the books, it was apparent. But the thing is, once it became clear to them, they weren't prepared to change their behaviors, because this was a deep-rooted belief that, well, you don't factor sales into the cost of sale. Well, yeah, you do. Yeah, you do.
Well, honestly, you don't have to, but then don't be surprised, right?
That's right.
Once you put everything together and the cash is not in the account at the end of the day, just account which one, which dollar went where and why, and then decide whether you want to keep doing it that way or not.
Yeah, and we've mentioned Greg Crabtree a few times. He has this notion of labor efficiency ratios, and I often implement this with my clients, where we are working out some key ratios around how much something brings in and how much it costs, and then tracking those numbers month on month on month. And that then gives us the ability to make decisions about when is the right time to make the next investment. Now, that next investment could be a new customer service representative. It could be a new truck. It could be a new piece of manufacturing equipment. But having the insight to be able to say, right, okay, we've made the last investment is now returning us a return. So we're building up our cash balance. It will then give you the trigger point to say, okay, we can now spend this amount of money on that investment. And that's going to drop your profit. But then as long as you've made the right investment, it's going to give a return. And you end up with this sawtooth model where gradually you go up and then down and then up again. But because you're tracking those ratios, you can make the informed decision at the right time and not before. Because if you do it too early, you're going to kill your cash balance.
Absolutely. And look, the ratios are beautiful in a way, right? Because you just start looking at it, and you look at it month after month, and you're like, some things that been previously hidden become glaringly obvious, right? And sometimes really just about surfacing the information in a readable way. And Greg does a great job at that. I didn't want to go into that much of a technical detail in the card, because again, you can read a book, right? It's more about from the leadership perspective. What are the things to usually look out for if the cash is tight? And yes, you should always get a second pair of eyes on your financials and see what's going on in there. But there are some obvious things, right? Like, are you getting out of your labor what you expect? Are you investing in things with a predictable ROI, right? The ping pong table is a luxury. It's not an investment unless you absolutely need it to, retain the A players that you are looking for in your particular market. I'm not saying don't buy a ping pong table if you can afford it. So that would be an overinvestment. If the undercapitalization piece, right, when basically it actually costs you more to add another dollar of revenue that you realize. And if it costs you more than the margin that you make on the dollar, it's sucking your cash on somewhere. And again, that's fine. It's common. And it's healthy as long as it's controlled and predictable, and you can model it in advance and then see what is actually happening, right? But the big deal is not looking at the financials as a proactive measure of the health of the business, and just looking at the number at the end. You need to use accounting as a tool to run your business. I remember I've been a little bit obsessed about it. So running this 3-person company as we are building, I'm talking to my bookkeeper and say, hey, these are the things I want to see every month. I was like, we don't do that. Like, none of our clients are looking at a freaking balance sheet on a monthly. I said, well, I will.
Yep, absolutely. Yep. I think the last thing I want to flow in to this conversation is just the cycle time of money. Most companies, once they are spending money to generate revenue, there is a delay before the money actually comes in. And if you're lucky, that might only be the time that is needed to get the invoice processed. But for most businesses, they've actually got to do some design work or some development work or some implementation work or some service delivery work. And then the invoice goes in. And I've seen examples where people are basically acting as their customers' banks, their clients' banks for 6, 9, 12 months in some cases. And just because you've made the sale doesn't mean the invoice has been paid. So a sale in a lot of business is not revenue. It is a promise of future revenue if you deliver okay. And if that cycle time takes too long, then you just grow broke. You run out of cash before you're able to send out the invoice because the right criteria haven't been met before the invoice can go. And that's another really, really dangerous way to drive your business into the ground, just by not being aware of how long it takes to get money back into the business.
Then you have the opposite situation. You have some great businesses that get money from their customer long before they have to pay the cost of what is it they're actually selling, right?
Yeah, absolutely. It then becomes a customer-funded business. The customer pays before the service is delivered, and that's an awesome business model. Anything you can do to reduce your cycle time and even get it negative's a good thing in this case, then that's going to make your business a lot stronger. That's going to make your business model much more robust and predictable.